The Stack, a podcast for IT and MSP professionals, with your host, David Papp.
Welcome to the MSP Stack Podcast. I'm your host, David Papp. Reed Warren joins us from IT Valuations. It's been his job for the last 13 years to help IT services and technology firms value their businesses and facilitate M&A activities, mergers and acquisitions. There's a lot involved in doing deals, and working out exit strategies, including valuations, letters of intent, due diligence, finances, agreements, closures, and all the post-deal strategies. Welcome, Reed. Let's talk about some valuations and multiples going into 2022.
Hey, thanks so much, David. Really appreciate that. And as we jump into it, obviously 2021 was a hot year. We saw lots of transactions. We saw valuations start to climb up. And, everybody's wondering what's going to happen in 2022. It's off to a great start, right? We're seeing continued high level of velocity, but we are seeing some changes in the marketplace. And it's going to be interesting to actually watch and see how this pans out. First of all, I would just say we're certainly seeing more sellers enter back into the market. So 2021 was a difficult year from that perspective, just because, coming off of COVID in 2020, a lot of sellers were feeling uncomfortable about their financials. They took a little bit of a dip as they're coming through 2021 and now showing a year of some pretty good growth because the market grew pretty significantly. We saw about a 10% growth in the MSP market and similar growth in the ISV market, as well as custom application. Really anything in technology did well in 2021. As a result of that, people are feeling more comfortable about their numbers, and we're just seeing a greater influx of sellers into the market. What does that mean? I do think that means that there's going to be a little bit of, we'll see the multiples start to actually cool off a bit. There was such a shortage of sellers. There was a really high supply and demand issue when it comes to sellers, right? And so as a result, those sellers that sold in 2021, we saw those multiples tick up, in no small part because of the shortage of sellers. We also saw such a huge infusion of private equity into that market, and which also really drove up the multiples. As we come into 2022, a couple things are happening. So one, an increase in number of sellers, which I think is going to cool the market a little bit. The other thing is we're seeing interest rates start to go up. As the interest rates go up, that's going to end up having an impact on cost of capital. And so for the strategic buyers who are looking to do really debt financing to fund the acquisition, we're going to expect that those multiples are going to start to drop down a bit, simply because they can't afford to buy as much. So what does that mean? That typically means if you're under $1 million in EBITDA as a firm, you're going to see those multiples actually start to dip back down and go down a little bit. That said, when we look at the private equity market, about a quarter of the private equity market starts to tap in and start to acquire firms that have at least $1 million in EBITDA. About half the private equity market starts to come in once you have $2 million in EBITDA. And so as you move as a business through that 1 million into 2 million and above, we're expecting to continue to see the market be really hot. We don't expect to see really multiples drop off at all, just because there is still such a shortage, and there will be a shortage of sellers in that over 2 million in EBITDA IT services firms. And from that perspective, I would say, as a rule of thumb, if you're under 500,000 in EBITDA, you're probably seeing a 4 to 5.5 maybe X multiple on EBITDA. As you start to come to that 1 million, you're starting to put into that 5.5, maybe 6 times trailing 12 months EBITDA. Once you get over 2, you're pushing into the 7s, possibly low 8s. And then if you're over 5 million in EBITDA, you're really seeing 9 to as high. I've had clients that have sold us for as high as 12x EBITDA in that space. And really, so as we look at it, in that over 2 million in EBITDA, don't expect to see any slowing in the marketplace. In the sub $2 million category, I do expect to see slowing, and the multiples start to drop down a bit in 2022 for the reasons that we've talked about.
Yeah, no, that's awesome recap. So For our listeners, let's say that you're an entrepreneur, you started up this tech firm business and you're wondering, well, what kind of multiples can I expect from, if I want to consider an exit strategy right now? You did allude that there are different types of buyers out there, like the PE firms, private equity. One thing I always like to use as a trick for folks is, take yourself as the owner out of the picture, remove all those write-offs and that crazy salary and the dividends and everything that you were doing and paying for your kids' cell phones and your home internet and all of that stuff in your vehicle. And of course, the travel trips.
Right.
And basically replace yourself with some kind of six-figure general manager. And that is pretty close to what your EBITDA is going to look like on your bottom line. I mean, of course, you're going to go through some kind of due diligence phase where they're going to look over your financials. And that's where I think COVID really had an impact on people, because like this big technology button got pressed and it reset things and kind of screwed with the numbers a bit. And most deals, I don't know what you're seeing out there, but you kind of look at the last 2, maybe 3 years on what your financials are, and you kind of base it on those kinds of averages. And so I've noticed, and I've always cautioned people, you know what? It's okay to wait too. If you want to work on your numbers and get things ready and get it ready for yourself to be extracted from the picture, start getting yourself a preparation, maybe hire yourself somebody like yourself, Reed, or a business coach or whatever. And 12 months later, the time might be even better for you.
I totally agree. As much as people go, hey, the market's hot, should I sell? The answer is maybe, and only if it hits your exit strategy, right? So you're only sell your business once. And if it doesn't get you to your exit strategy, then you shouldn't sell, regardless of how hot the market is. Because in the end, you either got to go do it all over again, or you got to buy something else at a premium to continue to drive it and run it forward. So from that perspective, you got to know what your exit number is. You got to know, you have to have that strategy in place. You have to have envisioned life beyond your business. And to everything you talked about, you got to be able to disengage from your business. And so there's a lot of things that go into getting ready to sell. And just because the market's hot doesn't mean you should sell. That said, if you've hit those numbers, and I would tell you with all the risk in the market as well, once you hit that magic number, that exit strategy number, you need to execute to it. Because, hey, the reality is you're only one ransomware attack away from having your business either cut in half or out of business in those kind of cases. And so really got to look at it from a risk mitigation perspective. All that said, if, when we work with sellers, it's what is that exit number? And then what's the lowest risk path to that? Can you do it organically in the next couple of years or whatever your time horizon is? And if the answer is yes, that's going to be your lowest risk option. If you're saying, hey, I'm further away from that, then we can look at accelerating the growth rate through an acquisitive strategy. It says, hey, I should buy a couple of companies because now I'm going to be able to grow faster. I can get to my number. But for an acquisitive strategy, you really need to have a 5-year or longer time horizon before you exit. And then what we're seeing a lot of today is people that don't have over 5 years, but they're not at their number. They can't organically grow there. And so we're just seeing a lot of people consolidate and really merge the companies as kind of a cash-free, tax-free merge. As a result of, kind of talking about the multiples that we looked at earlier, if you're $1 million firm and the other company's $1 million firm, well, now you're $2 million in EBITDA. As a result, you're going to get 1 to 2 turns higher as a result for having merged and position yourself now in a place with some minor consolidations. And typically when we see a merger, we're going to see typically a 25 to 30% increase in your portion of the value of the business that you're merging in. So when you look at that, it is a great way to be able to accelerate to a transaction and to an exit strategy faster.
That is such an awesome point. People always, they don't realize, it's kind of like Hollywood, I say, when you see these guys taking over all these businesses. And, it's typically the PE thing where they have no emotions and they just tear it apart when the deal is done. But that's not what we're seeing these days. Oh. We're seeing some more deals that are more mature and respectful of the existing client base, the staff, keeping things maintained. There might be some consolidations and mergers and whatnot. There's usually a transition period, to get the owner out. And that could actually coincide with higher multiples if you have earnout periods where you're meeting some targets. Or if you just want cash out front and you're like, screw this, I'm done with this, you're going to get a lower multiple. So it really depends what you're looking for. But you brought up a really good point. And I'm kind of curious from your point of view, are you seeing people who are just, they want out right away and they're done, or are they still interested in this stuff and they want to be a part of it? So then now you have to create something that'll motivate that prior owner operator to keep them going, even though they don't really own the business anymore.
You're listening to The Stack.
Thanks to cybersecurity leader ESET for sponsoring the podcast. ESET delivers award-winning cybersecurity technology to protect all aspects of your digital life with cutting-edge expertise and advanced machine learning to secure Windows, Mac OS, and Android devices. ESET bundles antivirus, anti-spyware, device control, web filtering, two-way firewall, anti-spam, remote management, and two-factor authentication solutions, and is a recognized leader in home and business cybersecurity solutions.
What's in your stack?
Yeah, we see a number of things happening on that space. And I would just tell you, you don't want to sell when you want to be done, right? So we do have a number of clients that come to us and say, I am just burnt out. I can't do this any longer. I just want to sell. Get me the best offer you can. And almost every time you're going to leave 30 to 50% of your value on the table just because you're not ready. Yeah. And it's actually, in my opinion, it's a sad thing. Part of what motivated me to get into the whole M&A space was really to help owners. In my history and working with companies in the past, I've done a lot of buy-side representation, and hey, we're there to squeeze the seller out of it. And I did a number of transactions, quite candidly, that I sort of regret being a part of, because in the end, we took advantage of the fact that sellers just didn't know what they were doing and didn't know how much money they were losing. And I just, after those experiences, that's why I launched IT Valuations. Because I don't want to have a part of that. And I really am passionate about the business owner that has spent, 30 years building their business. It's now a $2 million, $3 million firm, and we want to get you fair value for your business. And so that said, for most people, when they go, I think I'm going to sell my business, from the time you make that statement to the time you're ready, it's typically about a 3-year journey of getting all your ducks in a row to be able to optimize your business for value. And so I want to make sure you hear that, because if you're coming in shorter than that and you're not ready, then you're going to be making these decisions about, hey, how much work do I really want to do? That said, coming back to your point, David, which is a really good one, we are seeing more and more, particularly in the private equity space, getting more sophisticated in a good way, where they're saying, hey, this isn't all about a cash out. This is also really about a cash in kind of scenario. Hey, we're going to take some risk off the table. For example, we're doing some work with New Charter. They've done some great transactions, and they really are, hey, look, we're gonna buy out 60, 70% of the business in cash. The rest is going to be rollover equity. You're going to continue to run the firm, get to be a part of this kind of cooperative that's going to bring a lot of value to the organization, help drive up your EBITDA, help improve your growth rate. You're still going to be running your business, right? And so we're seeing more and more private equity kind of do that and allow the owners to take risk off the table, but have an upside when they look to flip the private equity value. And we're seeing more and more of those kinds of things. We're also seeing more of the strategic sellers looking for great talent, right? And so we find that, particularly as you oftentimes, a lot of the sub $2 million market really got into because they love technology, and then they found out they have to be a CEO. And then by the time you're hitting 3 million, you're going, I don't know that I want to do accounting and payroll and taxes and all that other stuff. And so there is a pretty good movement by the strategic market to say, hey, we need better VCIOs. We need better strong technology that have an owner mindset. And we really want you to be around long term. And so we are seeing some really great conditions today. If you're interested in taking risk off the table, but still being a part of the long run, we're seeing that buyers have gotten more willing to be sophisticated and put together actually a program that's going to really work for you and really work for them as well to get to that return on investment that they need to get to.
Fantastic. So I always like to end the show with what I call, a single piece of advice, a power tip. What would be something that you'd want to share with people if they completely ignored or forgot or didn't understand what the heck you were talking about up until this point? What would that power tip be?
Yeah, I would say don't do it yourself, right? Most people aren't going to go sell your house without a real estate agent. Selling your business or buying a business is 100 times more complicated than selling your house, right? Or buying a house, right? And I would just tell you, our experiences, this is our clients, but this is going to be true of most good M&A advisors. We're going to bring, for sellers, we're going to bring 12 to 15% increase in value or cost savings, right? There's just so many places you lose money and you won't even know it until after the transaction's well over and you heard about it from somebody else who got a deal done right. And all of a sudden you're going, dang, I just lost $200,000. Didn't know I even lost it, right? And so I would just tell you, if you're looking at selling, you really need to have an M&A advisor in place that's going to really help make sure you don't step in those mines and make sure that you're getting the most for your business. And I would just say from a buyer's perspective as well, one of the things that we have a lot of buyers go, hey, I think I've done this before. One of the things that a good M&A advisor is going to do for you as well is just really be creative in deal structures and in terms such that we both win, right? The best thing as a buyer that you can have happen is the seller actually wins. And you don't want, and for you, it's less about the multiple. A lot of people feel, especially today, I'm like, man, I'm overpaying for that. Maybe not. If you have a good rate of return that's better when you get in the marketplace, then it's a deal you should do regardless of what the multiple is. And so having a good M&A advisor who can do the IRR modeling for you, make sure you get that rate of return. There's a lot of transactions that can be done today that just requires oftentimes some creative structuring from the buy side. So whether you're a buyer or a seller, don't try to do it on your own. Typically, you make mistakes that you regret later, and we're here to take those mistakes out of the equation.
Solid. That is fantastic. Thank you very much, and it was a great pleasure having you on the show.
Thanks so much, David. Really appreciate it.
We hope you enjoyed this episode of the MSP Stack Podcast. Remember, if you liked it, hit thumbs up. If you didn't like it, hit thumbs down twice. If you'd like to be on the show, head on over to the MSPstack.com and click on the Be a Guest button. The Stack is made possible through the generous support of MSP Corp. What's in your stack?